For millions of Americans, the dream of homeownership has felt increasingly out of reach. A perfect storm of soaring prices, elevated interest rates, and historically low inventory has created one of the most challenging housing markets in modern history. The affordability crisis has become a central economic and social issue, leaving many families wondering if they will ever be able to own a piece of the American dream. It is against this backdrop of widespread anxiety and financial pressure that the White House has decided to act, and to act decisively. In a move that sent shockwaves through the financial world and captured the nation's attention, President Trump has launched a significant and forceful intervention into the American housing market, an initiative he frames as a direct response to the struggles of working families. During a specially convened press briefing from the White House, he announced two major, concurrent actions designed to fundamentally alter the dynamics of the market and tackle the persistent issue of housing affordability head-on. These weren't minor tweaks or pilot programs, they represent a direct and muscular use of executive influence aimed at reshaping who can buy homes and how much it costs to finance them. The administration is signaling a new era of government intervention, a clear departure from the more hands-off approach of recent decades. The goal, as stated, is not just to provide temporary relief, but to rebalance the entire housing ecosystem in favor of individual homebuyers over large-scale financial institutions. The first, and perhaps most dramatic pillar of this new policy, is a direct challenge to a major force in the post-2008 housing market. In a bold declaration, Trump said he is immediately taking steps to ban large institutional investors from buying more single-family homes. This measure specifically targets the private equity firms, hedge funds, and other large-scale corporate entities that have purchased hundreds of thousands of houses across the country, often converting them into rental properties. That move targets the heart of corporate ownership of residential properties, a trend that many critics argue has priced out first-time buyers, reduced the available supply of homes for sale, and contributed to the rapid increase in both home prices and rents. By attempting to sideline these cash-rich professional buyers, the administration hopes to level the playing field, giving ordinary families a better chance to compete and win bidding wars for the limited number of homes on the market. The policy is a direct bet that removing this source of demand will cool price appreciation and restore a sense of fairness to the home buying process. Simultaneously, to address the other side of the affordability equation, the cost of borrowing, he directed the government-sponsored enterprises, Fannie Mae and Freddie Mac, to begin a massive new round of market support. They have been instructed to purchase $200 billion in mortgage-backed securities, commonly known as mortgage bonds. This is a classic yet powerful tool of monetary policy. By creating immense new demand for these bonds, the government aims to drive up their price. And because bond prices and yields move in opposite directions, the intended effect is to push down the yields on these securities, which are the primary benchmark used by lenders to set the interest rates on 30-year fixed-rate mortgages. Taken together, these twin policies, one targeting who can buy and the other targeting the cost of buying, are among the most direct presidential efforts to reshape the fundamentals of the housing market in recent memory. It represents a significant gamble, intervening in two core aspects of the market at once. As expected with an announcement of this magnitude, markets reacted right away, sending immediate and powerful ripples through the financial sector. The stocks of publicly traded institutional landlords plummeted on the news of a potential ban, while homebuilder stocks rallied on the prospect of reduced competition and lower mortgage rates stimulating demand for new construction. The bond market began pricing in the massive new purchases, with traders scrambling to anticipate the full impact on yields. The policy immediately sparked an intense and polarized debate among economists, housing analysts, and political commentators about who stands to win, who might lose, and what unintended consequences could emerge. Will this truly help first-time buyers, or will it simply shift market dynamics in other unpredictable ways? And most importantly for millions of households, what does it all mean for the average American's mortgage payment, their ability to qualify for a loan, and their prospects of finding a home they can afford? The motivation behind this sweeping agenda is clear, and it was articulated in a powerful soundbite from the announcement. The president declared, "The era of Wall Street buying up American neighborhoods is over. We are putting the American family back in the driver's seat. 2026 must be the year we get housing affordability right for working families." This statement sets a clear political timeline and a high bar for success. The implications are vast, touching every corner of the economy from Wall Street trading desks to suburban cul-de-sacs. To understand what comes next, we need to go beyond the headlines. This video will break down the fine print. We will analyze the mechanics of both the institutional buyer ban and the mortgage bond purchase program. We will explore the immediate and potential long-term market impact. And most critically, we will dissect the stakes for prospective homebuyers, current homeowners, and renters to provide a clear, unbiased guide to one of the most significant housing policy shifts in a generation. In a sweeping move aimed at reshaping the American housing landscape, the White House has unveiled a new, aggressive policy agenda. At the forefront of this strategy is a dramatic directive designed to curb the purchasing power of large institutional investors in the single-family housing market. This policy, the first and most significant pillar of a broader housing affordability plan, signals a fundamental shift in how the government views the role of large-scale capital in residential real estate. It's a direct response to years of public outcry and growing economic data, suggesting that the dream of homeownership is slipping away for many American families, in part due to intense competition from deep-pocketed corporate buyers. The administration is framing this not just as an economic policy but as a social imperative to rebalance the market in favor of individual homebuyers. The policy was distilled into a simple, powerful slogan: people live in homes, not corporations. This message is crafted to resonate with millions of aspiring homeowners who feel they've been unfairly sidelined. It paints a clear picture of the intended beneficiaries: everyday families, couples, and individuals seeking a place to call their own, not just a line item on a corporate balance sheet. The underlying philosophy is that single-family homes are a cornerstone of community and personal wealth building, and their primary purpose should be to house families, not to serve as a financial instrument for Wall Street. This populist framing sets the stage for a significant regulatory battle, pitting the interests of individual citizens against those of powerful financial firms. The primary goal is to prevent large-scale investment firms from acquiring more existing single-family properties to convert into rentals. The mechanism is a proposed ban on purchases by entities that own a significant number of homes, though the exact threshold is still being debated. The idea is to choke off the flow of institutional capital that has been pouring into the market, a trend that many analysts believe has artificially inflated prices and reduced the number of homes available for sale to owner-occupants. By taking these major buyers out of the equation, the policy aims to level the playing field, giving traditional homebuyers a better chance to compete on offers and secure a home without being consistently outbid by all-cash offers that are often well above the asking price. The specific targets of this policy are the titans of the financial and real estate worlds. This includes private equity giants, large-scale real estate investment trusts, or REITs, and other institutional funds that have amassed vast portfolios of single-family homes. These are not your typical mom-and-pop landlords. We're talking about sophisticated financial operations that leverage complex algorithms to identify and acquire properties at scale, often sight unseen, across multiple states. Their business model relies on achieving economies of scale in property management and generating steady rental income and long-term appreciation for their investors. This single-family rental model accelerated dramatically in the wake of the 2008 financial crisis. As millions of homes fell into foreclosure, private equity firms saw a historic opportunity. They swooped in and bought up thousands of distressed properties at bargain prices, transforming what was once a fragmented, locally owned rental market into a new, institutional-grade asset class. This strategy proved incredibly profitable, and the model has only grown since, attracting billions of dollars in investment and expanding its footprint from distressed markets to nearly every major metropolitan area in the country. Administration officials and housing advocates argue that the practices of these firms have created an unfair market. They contend that these companies consistently outbid families by leveraging significant cash advantages, waiving inspections and other contingencies that individual buyers rely on. This firepower not only wins them the property but also drives up comparable sales in the neighborhood, pushing prices even higher for the next buyer. The result, they claim, is a shrinking inventory of for-sale homes accessible to the middle class and a growing pool of permanent renters who are locked out of the wealth-building opportunities of homeownership. However, turning this policy from a slogan into law will be a monumental task. The precise definitions of what constitutes an institutional investor will need to be carefully codified by Congress and relevant federal agencies, like the Department of Housing and Urban Development and the Treasury. Key questions remain. What is the ownership threshold? Will it be 50 homes, 100, or 1,000? Will the ban apply nationwide or only in overheated markets? And how will the government track and enforce these rules across a complex web of LLCs and subsidiaries designed to obscure ownership? The path from proposal to implementation is fraught with legislative hurdles and bureaucratic challenges. While the legal language is still being drafted, the intended targets are clear. The policy is aimed squarely at the largest players in the single-family rental space, companies like Invitation Homes and American Homes 4 Rent, which are publicly traded REITs owning tens of thousands of properties each. It also targets the financial behemoths that back these operations, such as Blackstone, which was instrumental in creating the institutional single-family rental industry after 2008. These are the firms that have the scale and market power that the administration seeks to curtail. The influence of these firms is not uniform across the country. They loom particularly large in certain metropolitan areas, especially within the Sun Belt. Cities like Atlanta, Georgia, Charlotte, North Carolina, and Phoenix, Arizona, have seen a huge influx of institutional investment. In some specific zip codes within these metros, reports indicate that large investors have been responsible for purchasing 20, 30, or even 50% of the homes sold in a given period. It is in these concentrated markets where residents and local officials claim the negative impacts, soaring prices, and diminished home ownership opportunities are most acutely felt. Critics of the ban, however, are quick to point out that on a national scale, the picture looks very different. Nationally, institutional investors, often defined as those owning 1,000 or more homes, own a relatively small fraction of the total single-family housing stock, estimated to be between 1 and 2%. They argue that blaming this small segment for a nationwide affordability crisis is a misdiagnosis of the problem. The real culprit, they contend, is a chronic, decades-long failure to build enough new housing to keep up with population growth and demand. It's also crucial to distinguish between different types of investors. While headlines often focus on Wall Street, the vast majority of rental properties are not owned by large corporations. Data shows that while investors bought roughly 1 in every 3 homes sold in a recent quarter, more than 90% of all investor-owned single-family homes belong to small, mom-and-pop owners who hold 10 or fewer properties. Policymakers will face the delicate task of crafting exemptions to protect these smaller landlords, who are a vital part of the housing ecosystem, while still targeting the large-scale aggregators. The policy will also need to address the build-to-rent sector, where firms construct entire new neighborhoods specifically for rental, which adds to the housing supply rather than subtracting from it. Supporters of the ban acknowledge the national statistics, but argue that local impacts are real and severe, justifying targeted action. They maintain that even if the national market share is small, the concentrated buying activity in specific neighborhoods can have an outsized effect on pricing and competition, creating significant barriers for first-time homebuyers. For them, the policy is as much about sending a message as it is about market mechanics. It's a declaration that the government's priority is to support aspiring homeowners and restore a sense of fairness to the market, even if it means taking on some of the most powerful financial interests in the world. The ultimate success of this ban will depend on its final structure, its enforcement, and whether it is paired with other policies that address the fundamental shortage of housing supply. The second action is a massive financial injection into mortgages. Fannie Mae and Freddie Mac were directed to buy $200 billion in mortgage-backed securities. He positioned it as a direct way to lower mortgage rates and boost affordability. When these agencies buy mortgage bonds, demand surges, pushing bond prices up and yields down. Lenders base rates on these yields, so consumer mortgage rates tend to drop. The mortgage market is about $14.5 trillion. $200 billion is material, but not dominant. It would nearly double combined holdings already exceeding $230 billion. FHFA Director Bill Polt confirmed execution has begun, including an initial $3 billion buy, with rates dipping to 5.99%. A buyer on a $3,000 budget gains roughly $14,000 in home price capacity. Markets responded swiftly, splitting winners and losers. The mortgage directive triggered a rate drop, with the daily average 30-year fixed at 5.99%, the the lowest in years. Redfin data shows a quick move from 6.21% to 5.99%. That was an immediate, tangible benefit for buyers. Meanwhile, publicly traded landlords sold off on the ban threat. Invitation homes fell more than 7%. American Homes 4 rent dropped 6.3%. Blackstone sank more than 4%. Opendoor traded down as much as 11.5%. Traders priced in lower yields, lenders passed relief to consumers. The two-pronged policy favored homebuyers while pressuring corporate landlords. It set the stage for a political and economic battle over corporate roles in housing. In the near term, continued downward pressure on mortgage rates is likely. As purchases continue, borrowing costs should stay lower than otherwise. Lower rates can re-energize buyers, especially in entry-level and mid-range tiers. Sellers could see faster sales and price support. Industry activity may pick up across agents, brokers, and builders. In markets where big firms were active, fewer all-cash offers could reduce bidding wars. Traditional buyers may gain ground. Some metros could see cooling price appreciation. Anticipating rules, some firms might sell holdings, briefly boosting for sale supply. Smaller investors could expand with less corporate competition. Short-term dynamics will vary by region. Lower rates lifting demand as investor pullback tempers prices in targeted areas. Experts are divided on long-term impact. Many argue the real issue is a shortage of homes, not just who buys them. As Fairweather puts it, the reason housing is unaffordable is a shortage of homes. Decades of underbuilding, especially entry-level, created persistent scarcity. From this view, investors are a symptom, not the cause. JP Morgan notes $200 billion is only about 1.4% of the $14.5 trillion mortgage market. Economist Joel Berner says past success came when purchases were large, sustained, and predictable. A short-lived program may not permanently alter rates. Rates also hinge on inflation and Federal Reserve policy. Supporters counter that lower rates can spur building, easing supply constraints over time. They also argue the ban protects neighborhoods from converting to rentals at scale. Skeptics warn of misdiagnosing the problem. Policies focus on demand, not supply. Tom Malone says a ban might reduce prices, but only modestly. He cautions that removing institutional demand could chill new construction. Investors often buy new homes, including entire phases, de-risking projects. If that demand fades, housing starts could slow. Skepticism also targets the bond buys, effective short-term, uncertain long-term. Bigger drivers remain inflation expectations and the Fed. A buyer class ban sets a precedent, possibly inviting legal challenges. Institutional landlords provide managed rentals for people who rent by choice or necessity. Cutting that supply without alternatives could tighten rentals and push rents up. Affordability problems could simply shift to renters if supply is not addressed. For a growing number of advocates, the recent government intervention in the housing market isn't a radical overstep, but a necessary correction to a system they argue has become fundamentally tilted against ordinary families. The core of their argument is that the dream of home ownership, long considered a cornerstone of the American middle class, has been slipping out of reach, not just because of economic cycles, but due to a structural shift in who is buying homes. They argue that large-scale corporate buyers, armed with sophisticated algorithms and vast pools of cash, hold an insurmountable and unfair advantage. These institutional investors can analyze market trends in real time, identify entire neighborhoods for acquisition, and make all cash offers that individual homebuyers, reliant on traditional financing, simply cannot compete with. This isn't a level playing field. It's a battle between family savings and institutional capital, between a mortgage application and a machine learning model designed for maximum yield. The direct consequence, supporters claim, is a significant drain on the available housing stock. By systematically snapping up homes, often in the most desirable entry-level and mid-tier price ranges, these corporations effectively convert owner-occupied communities into rental portfolios. This strategy directly reduces the inventory of homes for sale, creating artificial scarcity. With fewer homes on the market and undiminished demand, the basic laws of economics take over, putting relentless upward pressure on prices and locking out a generation of potential buyers. This narrative has found fertile ground across the political spectrum. As analyst Jarrett Seiberg of TD Cowen Washington Research Group notes, the idea of curbing corporate landlords appeals powerfully to MAGA populists, who see it as protecting the American way of life from Wall Street overreach. At the same time, the policy has consistent champions among progressive Democrats, who frame it as a matter of economic justice and a check on corporate power. This unusual bipartisan appeal is a key driver of the policy's momentum. At its heart, this debate is about more than just market mechanics. It's about a fundamental vision for society. For proponents of the ban, homeownership is seen as central to community stability and the primary vehicle for middle-class wealth creation. They argue that homeowners are more invested in their local schools, civic life, and the long-term health of their neighborhoods. When communities transition from owners to renters, they risk losing that social fabric, becoming more transient and less cohesive. Alongside the proposed ban, the administration has deployed a second, more immediate tool, directing government-sponsored enterprises to purchase $200 billion in mortgage-backed securities. Supporters hail these bond buys for providing immediate, tangible relief on borrowing costs. By increasing demand for these bonds, the government pushes their prices up and their yields down. Since these yields are a primary benchmark for 30-year fixed mortgage rates, the effect trickles down directly to consumers in the form of lower monthly payments. Proponents argue the two policies are designed to work in tandem, creating a powerful one-two punch. The ban on institutional buyers is intended to level the playing field and reduce competition for scarce inventory, while the bond purchases simultaneously work to lower financing costs. The combined goal is to create a market that explicitly prioritizes households over corporations, making the path to owning a home both more accessible and more affordable. With this dual-pronged strategy now in motion, momentum is building for more permanent measures. The initial ban, enacted through executive authority, is seen by many as a temporary fix. The real test will be whether Congress acts to codify a federal ban on institutional purchases of single-family homes, a move that would have far-reaching and long-lasting implications for the entire housing industry. This brings us to the critical questions that will define the next chapter. First, will a deeply divided Congress find the common ground to pass lasting legislation? The path is fraught with legal and political challenges, from defining what constitutes an institutional buyer to fending off inevitable court battles. Second, will the mortgage bond purchases be sustained long enough to have a lasting impact on rates, or will they be a short-term stimulus that fades, potentially causing market volatility when tapered? And perhaps most importantly, will these demand-side interventions be followed by meaningful supply-side reforms? Experts on all sides agree on one thing: you cannot solve a housing shortage without building more houses. Without a significant increase in new construction, the effects of a buyer ban and lower rates may prove temporary. The same number of buyers will simply be competing for the same limited number of homes, which could keep prices stubbornly high. However, if paired with aggressive action to streamline zoning, speed up permitting, and incentivize construction, this moment could represent a genuine turning point for housing affordability in America. For now, the immediate effects are clear. Mortgage rates are lower than they would be otherwise, and the stocks of large-scale corporate landlords are wobbling under the weight of policy uncertainty. The market is reacting, and the pieces are moving on the board. But whether this represents a temporary market distortion or the beginning of a fundamental realignment of the U.S. housing market is a story that is still being written in real time.